Have you ever looked at the stock market with all its flashing numbers and crazy charts and just thought, what is the actual point of all this? Well, today we're going to demystify it. We're going to break down its real purpose and figure out if it's creating genuine value or something else.
And you know, this whole thing was kicked off by a fantastic question I saw on Reddit. Someone asked, do stock markets actually provide economic value, or is it just a system that enriches some investors? It's such a great question because it hits on a confusion a lot of people have. So let's unpack it.
So first things first, the stock market isn't some single building or website. It's better to think of it as a huge, interconnected system. And it really has two main jobs. Number one, get money to companies so they can grow. And number two, give regular people like us a chance to share in that growth. And to really get its value, we kind of have to look at how it all started. Way back, if you had a big, risky business idea, like, say, sending a ship on a dangerous voyage across the world, you had to pay for it all yourself. And if that ship sank, well, you lost everything. Then someone came up with a genius solution, the joint stock company. Instead of one person risking it all, you sell little pieces of the venture, we call them shares, to lots of people. This spreads the risk and pools the money. Fast forward to today, and our global markets are doing the exact same thing, just on an absolutely massive scale.
So when you put your money into this system, what are you actually getting? It's not just a random number on a screen. It really boils down to two fundamental things. You can either buy a piece of the company's future, or you can give it a loan. And that brings us to the big two, stocks versus bonds. When you buy a stock, that's also called equity, you literally become a part owner of that company. You get to share in the successes. But when you buy a bond, you're not an owner, you're a lender. The company is borrowing your money, and they promise to pay you back with interest. Ownership versus a loan. That is the fundamental difference.
And if you look at this table, you can see the trade-off really clearly. With stocks, because you're taking on the risk of being an owner, you have a much higher potential for reward. If the company hits it big, so do you. With bonds, your return is usually lower, but it's also more predictable. You're a lender. You just want your loan paid back with interest. It really all comes down to that classic relationship between risk and reward.
Okay, so this brings us right back to that original Reddit question. The idea that companies don't actually use the funds you invest. And this is such a common misunderstanding. To clear it up, we need to know that the market really has two different arenas. First up, you have the primary market. This is where it all begins. Think of this as the fundraising stage. A company needs cash to, say, build a new factory. So it creates brand new shares of stock and sells them to investors. And here's the key. The money from that sale goes directly into the company's bank account. The most famous example of this is the IPO, the initial public offering. You've heard of it, right? A private company decides to go public. It creates a bunch of new shares, investors line up to buy them, and boom, the company gets a massive injection of cash to fuel its growth. This is the direct funding engine of the stock market.
But what happens after the IPO? Well, that's where the secondary market comes in. This is the market you hear about on the news every single day. The New York Stock Exchange, the NASDAQ, the whole shebang. In this market, investors are just buying and selling those already existing shares from each other. The company itself isn't getting any of that money.
And this is the light bulb moment. So you see, the person on Reddit was half right. Money traded on the secondary market doesn't go to the company. But this market provides something absolutely vital, liquidity. Now that's a fancy word, but all it means is you can easily sell your shares and get cash back. I mean, think about it. Would you ever give a company money for a share if you knew you could never ever sell it? Probably not. The secondary market makes that initial investment so much less risky, which encourages way more people to fund companies on the primary market in the first place.
So now that we get the mechanics, let's talk about the people. How do folks actually approach this system? Well, it turns out there are two completely different mindsets you can have.
On one hand, you've got investing. The motto here is time in the market. This is the long game. We're talking years, decades even. You buy into solid companies and just let your wealth grow slowly and steadily. Then you have trading, and the motto here is timing the market. This is all about short-term moves, trying to profit from price swings that happen over minutes, days, or months.
And trading, it might sound glamorous, but it is incredibly tough. It's a huge psychological battle. You're fighting your own brain, which is wired with all these biases, like revenge trading to win back money you lost, or getting overconfident after a couple of lucky wins. Honestly, for most of us, the disciplined, long-term mindset of an investor is a much more reliable path to success.
And if you choose that path, the path of the long-term investor, you have an incredible superpower on your side. That superpower is time. And time unlocks the most powerful force in all of finance.
Yeah, even Albert Einstein was apparently a huge fan. He supposedly called compound interest the eighth wonder of the world. It's this beautiful idea that your money earns returns, and then those returns start earning their own returns. It creates this incredible snowball effect over time.
And this slide, wow, this is where it all clicks. Just look at these numbers. If you start investing $500 a month at age 21, you could have almost $1.4 million by retirement. But wait just 6 years until you're 27, that number drops by nearly $500,000. Wait till 37, and you've left almost $1 million on the table. That is the insane power of compounding. Time is your greatest asset.
And here's another way to look at it. Let this sink in. If you start at 21, by the time you're ready to retire, a staggering 80% of your nest egg could come from growth alone. Only 20% is the money you actually put in from your paychecks. Your money does almost all of the heavy lifting for you, but you have to give it time.
Okay, all that growth sounds amazing, right? But it doesn't come for free. The market always has risk. The goal isn't to avoid risk, that's impossible, but to be smart about it.
And luckily, there are proven strategies to do just that. You've heard of diversification, right? Don't put all your eggs in one basket. Then there's dollar cost averaging, which just means you invest the same amount on a regular schedule no matter what the market is doing. It helps smooth out the bumps. These aren't secrets, they're just the fundamental tools for playing it smart.
So just remember, risk is part of the game. You can't get those higher returns without it. The key is to manage it, to build a plan that lets you sleep at night, and to stay focused on your long-term goals, not the crazy day-to-day headlines.
Which brings us right back to the beginning. The stock market is so much more than a casino. It's a powerful engine that funds innovation and economic growth, and it's a tool that allows any of us to build wealth over time. So the real question isn't whether the market has value. It's how will you choose to use these tools for your own future.